Germany is in trouble. Amid an energy crisis, a dip in production, and a failing property sector, Germany is on the brink of bankruptcy, and it is poised to take the entire EU with it. Let's get started. The sick man of Europe. Back in 1998, the post-reunification economy of Germany was turbulent. Such hard times had earned the country the moniker, the sick man of Europe. Now the title has made an official comeback. It's hard to summarize the fall of the German economy in 2023, but what you promptly need to know is that Germany's economy contracted in every quarter of the year. Now, Germany's Chancellor Olaf Scholz will tell you that Germany's recession is temporary, but economists predict that the year 2024 will be equally poor for the country. The Scholz administration shouldn't be surprised, though. Even today, Germany is the biggest economy in the European Union. However, it was the last to recover from the pandemic shutdown. Since then, Germany isn't living up to its full potential. If we have to diagnose the tipping point in the economy, it's quite simple. We wouldn't have to look any further than the automobile industry. German cars and their exports are the heart and soul of its economy. In 2022, cars accounted for 15.6% of the value of German exports. All things considered, this figure is pretty low. Overall, the value of exports has dropped dramatically. In May 2022, Germany reported a foreign trade deficit for the first time ever in the recent past. The figure dropped to 1 billion euros. And in 2023, Germany surprisingly posed an increase in trade surplus with a value of 18.7 billion euros. But for the largest economy in the EU, that isn't enough. As Germany ends the year in recession, the entire Eurozone is going to feel the impact. The thing is that Berlin isn't going to suffer the turmoil of its economy alone. The entire European Union is susceptible to getting hit by the shockwaves. And here's why. Business is dying in the European Union. Business activity in the EU is dying. We don't have to give you a lesson 101 on the interconnectedness of the economies. But over the years, the deep regionalism in Europe has crowned Germany as its leader. Berlin showed incredible progress in the aftermath of the 2008 economic crisis. Ever since, its economy grew by 2% every year until recently. It isn't surprising that the growing manufacturing sector in Germany was a hit. Many European businesses rushed to the country for new opportunities. At the same time, big corporations were also setting up shops in Germany. As of now, big names like BMW, Audi, Siemens, Mercedes-Benz, Allianz, and Adidas, among others, manufacture in Germany. In particular, workers from Eastern Europe found a new economic boom in the hub of the EU. However, gradually, Germany's reputation as a business hub is fading away. Now, there are many reasons why production is slowing down in the country. Foremost, Germany's ambitious plans to go carbon neutral by 2045 seemed very optimistic. For an automobile manufacturer, that was always going to be an unpopular decision. However, the country has also failed to earn the trust of its key investors. Major moneymakers in Europe are shifting their focus away from Germany. After all, the economy is showing no prospects whatsoever. Believe it or not, in comparison, Eastern Europe seems lucrative. Alternatives like Romania and even Hungary are open for employability. Plus, they are heavily investing in their manufacturing sector. And well, it's a major downside for the emerging labor market. But these hubs offer cheap and long-term workforce. Not to mention, these countries aren't too particular about fostering labor rights. But of course, that transition is going to be costly. For the most part, Germany had a safe infrastructure for businesses to grow, and to make money, of course. The new alternatives are reasonable, although their business environment is yet to grow. But the problem is quite simple. In Germany, production is declining every single day. Experts had predicted a drop of 0.1% in production. However, by the end of September, the output decreased by 1.4% compared to August. The impact of the drop was instant. For the first time in decades, German companies started to shred jobs. Since the demand for exports dropped in the country, companies had no avenue to pay their employees. In particular, short-term and contract hiring has decreased a lot. So for the rest of the EU, Germany isn't the typical place to foster employability. The issue at hand is simple. With rampant unemployment at home, Germany can't host potentially new immigrants or students. Overall, Germany's image as the flag bearer of the EU inclusion is faltering. But that's only one of the many issues that plague the German economy. One of its biggest problems might as well be Scholz's worst nightmare: the inflation problem. Living in Germany is a disaster now, quite literally. The decline in exports and the violent war in Ukraine have pushed the economy into deep inflation. Here's the thing. It is inarguable that the issues of inflation and recession are common to the EU. However, inflation in Germany is hotter than its neighbors and trading partners. The inflation rate in the Eurozone, on average, is 5.3%. But Germany's inflation outlook is more bleak. In July 2023, the inflation rate in Germany was more than 6.2%. In the post-COVID world, Germany was supposed to be the savior of a faltering EU economy. Yet the reality couldn't have been more different. Firstly, the companies were hoping for an increased local demand. And secondly, they were hoping for the consumer price index to go down. Needless to say, neither of these expectations were met. As of now, Germany's condition is best diagnosed as sticky inflation. While the problem has improved since October 2023, progress is still slow. The long-term inflation issue has resulted in many turbulent problems like investors' disinterest. However, the most rampant problem is the diminished purchasing power of the average German citizen. The current pessimism among households has had an obvious impact. Germans are just not interested in buying stuff anymore. Truly, the hub of consumerism is dying down. Even the upper middle class faction in Germany is unable to buy finished goods. Luxury cars and properties are just two of the most important commodities. In fact, the decline in public and private spending is the biggest driving force behind the recession. A basic rule of economics tells us that 2 consecutive quarters of declining output is classified as a recession. But for Germany, the degrowth of industrial output has been rampant since 2022. This tells us a lot about the devastating impact of inflation in the country. Many households are dealing with a sticky inflation in a very conservative manner. Germans are already being forced to pay high energy costs, so the urge to spend disposable income on shopping sprees is low. But not everything is dark and bleak. The German industrialists received some good tidings recently. While the energy prices remain high, the prices of consumer goods are stabilizing gradually. As of October, the measure of inflation is 3.8%. Back in September, the same rate was 4.5%, and the response from the government didn't seem too hopeful. Believe it or not, this slow decline in inflation has come after 2 years. During these tough 2 years, German natives had to grapple with a new crisis of their own as well. Today, an average German simply can't afford to buy a house. And for the country that values its property sector, that's bad news. So, what's happening? It's expected that the quickest mechanism to control inflation is to hike interest rates. And well, thanks to the Eurozone, the inflation in Germany isn't just Germany's problem. In August 2023, the European Central Bank hiked its main interest to 3.75% to control the CPI. The spike in the main interest rate is actually historical. In the last decades, the European Central Bank hasn't had to resort to this measure. But of course, high interest rates don't only matter to investors. The high cost of borrowing money has hit Germany's residential building sector hard. The additional costs of the mortgages have skyrocketed. Aspiring homeowners simply don't have the extra money to keep up with high interest rates. More than 40% of construction companies in the country have reported a decline in consumers. So there are 3 important tangents here. First, the rising cost of construction is choking off the property sector in Germany. The new apartment complexes or townhouses are virtually empty. Secondly, Germany's trading partners in the European Union are also losing business. Construction companies don't have an incentive to import construction materials. And even if they do, the high taxation on import bills is getting very unaffordable. The third tangent is a widespread issue in Germany. As usual, it affects the rest of the EU as well. Students and recent graduates would know about this problem all too well. Due to the overall housing crisis in Germany, rents are through the roof. Now, an EU passport guarantees freedom of movement, but any student or business would refrain from living in the country. With hyperinflation, no one can foot a hefty rent for a small apartment in Germany. And the issue is untamable too. What's next for Germany? If we had to summarize Germany's turmoil, it will take only 2 names: China and Russia. The reason Berlin can't indulge its trading partners in the EU lies offshore. Chinese demand for its exports has almost died down. China has a fair share of its native problems. But it is important to remember that many local industries are producing everything Germany specializes in. That too, cheaply. Germany was hoping for a boost in its exports in the post-pandemic world. In return, China's crushing local demand produced a decisive result. China can't afford expensive German products. Major companies can't invest in the German economy when its clients are dying down. Not to mention, its recent standoff with Russian gas is pretty hefty too. Germany wasn't quick to cut its energy ties with Moscow, but the Western push was pretty definitive. And now the cost of taking a stance has caused an energy crisis in Germany. Utility bills are skyrocketing and industrialists can no longer afford them. All of these problems are pushing European industrialists away from Germany. In doing so, the EU will suffer immensely, and the year 2024 doesn't seem promising. Do you think the Scholz administration will avoid another recession in 2024? Let us know in the comments below.